Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories within company filings. And hint, hint, this one involves a lot of borrowing and lending, all right? So today we're diving into something a little different. It's a current report from the Federal Home Loan Bank of Topeka, FHLBank, filed on July 9th, 2025. This isn't your typical company report, but it gives us a peek into how these essential financial institutions operate and manage their money, especially when it comes to borrowing from the public markets. So what exactly is the Federal Home Loan Bank of Topeka, or FHLBank for short? Think of it as a cooperative bank for other banks. Its main job is to provide funding to its member banks, which are typically local banks and credit unions. This allows those local banks to then offer loans to their customers, like mortgages and business loans. So when you see FHLBank on a filing, it's all about its role in keeping the lending system flowing. The main reason FHLBank is filing this report is to tell us about its debt issuances, specifically what they call consolidated obligations. These are essentially bonds and notes that FHLBank sells to investors to raise money. Now here's a crucial point. These consolidated obligations by regulate solely on the financial strength of these 11 banks, or 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 strength of these 11 banks. Now, FHLBank is upfront about the details in this report. They mention that what they provide in this filing isn't meant to track their total debt outstanding, because they often issue short-term debt with maturities of a year or less, which isn't included here. They also point out that the amounts are reported at face value, which might differ from what you'd see in their full financial statements, where things like discounts and premiums are factored in. It's like them saying, hey, here's a snapshot, but for the big picture, you'll need to look at our other filings. Alright, let's get to the good stuff, the actual debt issuances being reported. This is where we can see FHLBank in action borrowing money from the capital markets. Here's a look at what they're issuing. First up, on July 9th, 2025, FHLBank issued a bond with a long maturity date of July 16th, 2040. This is a $15 million issuance with a fixed interest rate of 5.87%. The interesting part here is the optional principal redemption with an American call style. This means FHLBank can choose to pay back part or all of this debt early at its discretion on certain dates starting January 16th, 2026. It's like having the option to pay off your "is the auctionist rates drop." Then on the same day, July 9th, 2025, they issued another significant chunk, almost $235 million, maturing on February 11th, 2026. This one is a bit different. It's a non-Kepse and a variable single index floater. This means they can't call it back early, and the interest rate will change based on a specific index likely tied to short-term interest rates. It's like having a loan where your monthly payment can go up or down. Another issuance on July 9th, 2025 for $250 million will mature on October 10th, 2025. Also a non-keep and a variable single index floater. This one is a very short-term debt offering showing their need for quick cash flow. And another one on July 9th, 2025 for $250 million, maturing on July 15th, 2027. Again, a non-kit and a variable single index floater. These variable rate notes are very common for FHLBanks as they manage their short-term funding needs. Moving on to another $15 million issuance on July 9th, 2025, with a maturity in July 2000, similar to the first one. It's an optional principal redemption with an American call style, meaning they can pay it back early starting January 30th, 2026. Now looking at July 10th, 2025, we see a $20 million issuance maturing way out in July 2050. This is a fixed constant rate bond with a 6% coupon, and it's also an optional principal redemption with an American call style. This is a long-term loan with flexibility for FHLBank. Another issuance on July 10th, 2025 for $250 million, maturing in July 2027, is a non-cakes variable single index floater, again highlighting the use of variable rate debt for shorter term needs. Let's look at a couple of issuances on July 11th, 2025. These are both for $15 million each and mature on July 2nd, 2030. They are optional principal redemption bonds with a European call style and a fixed rate of 4.125%, a European call style and a fixed rate of 4.125%. A European call means they can only redeem it on a specific date, not continuously, like an American bond. Also on July 11th, 2025, we have a $250 million issuance maturing July 19th, 2027. This is a non-Kenny variable single index floater, continuing the trend of variable rate debt, and another $15 million issuance on July 11th, 2025, maturing July 15th, 2030. It's a fixed constant rate bond with a 4.25% coupon and a Bermudan call style. This means it can be redeemed on specified recurring dates after the first redemption date of January 15th, 2027. They also issued $50 million maturing July 16th, 2027, this time as a non-cabler's variable single index floater. And finally, on July 11th, 2025, a $25 million issuance maturing July 16th, 2030. This is a fixed constant rate bond with a 4.375% coupon and a canary call style. This style means it can be redeemed on specified recurring dates after the first redemption date of October 16th, 2025. Up until a specific date before maturity. After all these details, we see the signature from Brad Gentry, FVP, Director of Funding, Hedging and Member Product Pricing, dated July 15th, 2025. This confirms the authenticity of the report and highlights that the person mainly responsible for managing these massive borrowing operations has officially signed off. So, what's the story here? FHLBank is actively managing its funding by issuing a mix of long-term fixed rate bonds and shorter-term variable rate notes. The use of different call styles like American, Bermudan and European shows they're trying to get the best terms possible while retaining flexibility to manage their interest rate risk and potentially refinance if rates become more favorable. The sheer volume of these issuances underscores how critical debt markets are for FHL banks to operate and provide liquidity to the broader financial system. From my perspective, FHL Bank is doing what it's designed to do, which is raise significant capital to support its member institutions. The variety of instruments they use suggests a sophisticated approach to funding and managing interest rate exposure. The fact that these obligations are joint and several across all 11 FHL banks does introduce a layer of systemic risk. However, the purpose of these banks is to provide stability, so this shared risk is part of that system. A key takeaway is the ongoing need for liquidity, as shown by the many short-term variable rate issuances. They are constantly cycling through debt to meet demand. This constant borrowing and refinancing is the engine that keeps the lending flowing for thousands of local banks, and ultimately for you and me when we need a mortgage or a business loan. What's your take on FHL Bank's funding strategy? Does it give you confidence in the stability of the lending system? Or does the reliance on debt markets raise any red flags? Let me know your thoughts in the comments below. If you found this breakdown useful, please hit that like button and subscribe for more insights into the corporate world. Don't forget to join our Discord community linked in the description for more discussions and to connect with fellow corporate decoders. Thanks for watching. See you next time.